and I'd like to welcome John Mauldin. Thanks, John.
George, it's always good to be with you.
Well, you've got this new dividend shark that's performing pretty well. You knocked it out of the ballpark for the first time. This first
well, I'm a little I don't want to say nervous, but I've entered into a joint venture publishing, and where we are actually working with people that I've known for a long time to create what we call Yield Shark, and where we're looking for places around the world that have some yield to them, in a yield-starved world, that without having to get too aggressive. Part of that's looking for dividends and so forth. And the first 3 months have done very well. In fact, they've done better than it normally will. I mean, we're looking for 5% annual yields, and we've had some that did a lot better. And I won't even mention that number. And my publishers shot out a number bragging about it, and I had to shoot them an email and said, guys, we can't brag about numbers like this because, number one, you can't duplicate them. That's like telling people you're going to be able to get 20 or 30, 40% number. You just can't do that. We got lucky, and frankly, we need to take something off the table because this is about fixed income yield. And when you can sell a small portion of your portfolio and lock in something, you need to do that. So,
well, it seems to me,
but nonetheless, there's opportunities out there for people who are looking for dividends and yield and income, but you just have to be willing to get global with it. You can't look for it in bond funds. And frankly, we have a little bit smaller investors. One of the few times where smaller investors have a advantage over the big guys. Because let's say you're a bond fund, and a small bond fund would be $1 billion. Well, they can't put $1 million to work, or $100,000 to work, or $25,000 to work, because they're looking at putting, $10 million, $20 million to work at a time, but they're not going to take 5% of the entire capacity in one fund. So this gives smaller investors a chance to get at some of these yields that nobody's paying attention to in the large funds because they can't look at them. They're too small. But they're out there and they're covered. They're solid. I mean, these are good companies that aren't going away. And they're paying nice bonds. And there's some attractive preferreds out there that are covered that are going to give us really good yields for a few years. They're going to get called away from us, but that's one of those things that we can enjoy for 2 years, and then we'll worry about what to do with the money when it gets called away from us. And so we're going to start offering this and some other services that are very specific: buy this, sell this, that type of thing.
Can you talk a little bit about the earnings and business cycle versus the secular stock market cycle right now, and how you see the S&P and its earnings and what you see there?
Everybody assumes that the earnings cycles for corporation goes up and down with the economy. They assume that the earnings goes up and down with the business cycle, or the stocks go up and down with the business cycle. And the reality is all of those things, the business cycle, the earnings cycle, the economy, they have their own rhythm. And they influence each other, but they work in different cycles. And to give you, when we're talking about the earnings cycles, you typically have cycles where corporations begin to increase their earnings, and they increase their earnings every year, and the analysts start projecting these earnings out into the future. And then corporations will not quite meet the expectations, and then they won't meet the expectations again. And we get disappointed, and we start selling their stocks. Well, the reality is that if earnings within a corporation get to be too much, then their competition looks around and says, well, heck, we're going to go after that. And eventually those earnings are brought back to reality. They're brought back to more of a trend growth, if you will. So earnings go above trend, then they go below trend, and those cycles don't necessarily correspond with how the GDP or the economy is growing. You can have earnings falling in terms of their trend in the previous years while the economy is doing quite well. because there's a lot of competition, and that competition will drive earnings down. So it's not, in fact, sometimes you can have earnings in terms of expectations falling in the best economic times simply because the competition is out there. Some of the best earnings growth can happen in harder economic times for certain companies because they're taking market share. And their competition is so weak that they go away so that they're left with a bigger market share. They've got a product that people want or need, and they can cut back on their expenses and actually increase their profits. So all of these things have cycles to them. Well, and you just can't look at everything moving together because it doesn't move together.
So along those lines, where do you think we're at in the cycle, and what kind of correction over what period of time do you think this looks like?
Well, the earnings cycle is more than middle age now. So we would start to expect that the high earnings growth that analysts are projecting is not going to be met. And so they're going to start to disappoint. And those earnings in terms of their stock price, in terms of previous earnings, are going to start falling. And the growth might be 5% rather than everybody projecting 10%. It doesn't necessarily have to go negative. It's just going to disappoint for some time because trees can't grow to the sky. Earnings, by definition, cannot grow forever faster than the underlying economy.
Yeah, which means these PE ratios, forward-looking, everybody's looking at, are not as cheap as they appear to be if you go into a shrinking earnings situation.
Absolutely, and then that's what makes for market corrections when people go, oh, wow, these analysts were too exuberant. And the one thing we know, and I've documented this so many times over the years, George, analysts are really, really bad at predicting the future. I mean, as a group, they are worse than just throwing dartboards. Project the current trend, which by definition we know is going to change. But they don't notice that it's changed for at least a year.
John Mauldin, thank you so much for being on the George Jarkesy Show and your explanation.